Welcome back. You're watching Business Incorporated live on Channels Television. Well, South Africa's Reserve Bank is expected to raise interest rates to 4% at its Monetary Policy Committee meeting later this week as part of ongoing hiking cycle. Central Bank is set to add 25 basis points to the repo rate after it increased it in the last MPC in November, taking it to 3.75%. Forecasts show further hikes of 25 basis points in every quarter from now until the second quarter of 2023. Central Bank had not raised interest rates in the height of the COVID-19 pandemic for 6 consecutive meetings, and with the country's inflation edging higher, the SARB's interest rate normalization process will continue. And we'll see now we head on to our first conversation there with Matt Kindiger. It's all about inflation right now in the UK. Matt, great to have you, Matt.
Hi, thanks very much for having me on the show.
Yes, and we see Africa is not insulated from this inflation issue. Looking at South Africa right now, what do you think is stoking this inflation rate?
Yeah, certainly. So South Africa has seen inflation rise to a multi-year high in December. So the inflation rate rose to 5.9% at the end of last month. This is the highest rate since at least March 2017, so it's quite a significant jump. And it's also at the upper bounds of the South African Reserve Bank's limit or target limit, which is 6%. So South Africa has seen obviously a sharp increase in inflation. This has really been driven by an increase in domestic fuel prices, which has in turn been caused by higher global fuel prices. As we know, oil prices have risen quite significantly over the last 6 months or so. But there's also been quite a protracted, a chronic problem when it comes to shipping costs. And this has driven up the cost of imported products. So South Africa has a very open economy. It's a large consumer of imports. And the rise in global shipping costs has driven up the price of companies importing products into the market. So this certainly is contributing to much higher inflation in South Africa.
Right. And what is the outlook for inflation over the coming year?
Certainly, we would expect inflation to rise over the next few months before it begins to fall towards the end of the year. So there are a few things that will contribute to rising inflation in South Africa. That includes very elevated global commodity prices. Oil and non-oil commodities will remain elevated in our view until at least the end of the first half of this year. But additionally, from a domestic perspective, Eskom, the electricity producer, the electricity utility in South Africa, is proposing a 20% price increase through 2023 for its energy tariffs. We probably won't see a 20% increase. It will probably get something between 10 and 15%. But in any event, it will raise the cost of doing business and raise cost pressures in South Africa. So there are upward pressures on prices in the country, but there are a few things that will contain the rate of price increases. So although price pressures are rising in South Africa, a few things are in South Africa's favor. So the rand will be very stable over the course of this year, which will curtail the rise in imported products. And we are also seeing very strong agriculture production, which is containing food price inflation. Additionally, as you mentioned in the introduction, the South African Reserve Bank has scope to raise the interest rate. So if inflation does begin to accelerate, the Reserve Bank certainly will increase interest rates. So we don't see inflation rising very rapidly, especially after the first half of the year.
And how would businesses be, impacted by this rising inflation?
Certainly. So companies, at least in the short term, as inflation rises in South Africa, do face a bit of a dilemma. We have seen quite a sharp increase in the producer price index in South Africa. So producer prices in South Africa have risen by 10% year on year in December. Now, this is the fastest rate since at least March 2013. So quite a significant increase. But we are seeing companies struggle to pass this price increase on to their customers. And this is because aggregate demand in South Africa is quite weak. So demand dynamics across industries are quite subdued. And the market is also very saturated, so there's lots of competitive pressure. So in an environment where consumption and demand is quite weak, but there's lots of competition, price increases are very difficult to justify. So companies in South Africa over the next couple of months, well, for much of 2022, will need to decide between protecting their margins or raising prices in line with inflation. So a bit of a balancing act over the next 3, 6, 12 months.
Yeah, quite a balancing act. But all fingers, points to a rate hike. How do you see these hikes now impacting Southern African markets?
Yeah, certainly. So I think it's quite clear that the Reserve Bank will increase interest rates probably, at the next meeting, but possibly, we will see a few extra hikes over the next couple of months. The impact will really depend on the pace of the hikes, the rate, how fast they increase as well. In South Africa, the country is quite well positioned for a couple of interest rate hikes. But if we do see aggressive interest rate increases over the next 6 months, this could really negatively affect South Africa's economic recovery. And this is because the country is in quite a fragile position in terms of its growth outlook. We're not forecasting growth of more than about 1 or 2% in 2022. So the South African Reserve Bank really does need to decide whether it wants to curtail inflation or support the country's growth outlook, which is quite muted. So again, a bit of a tough decision there.
Quite a tough decision for them to make. That was Matt Kinniger right there, practice leader, Sub-Saharan Africa, in front of you. Thank you so much.
Thanks very much.